The crash of 1929 erased 86% of the value of shares. In 2008, €8 trillion disappeared within months. However, during all these crises, prepared investors not only survived, they thrived. In this video, you will learn about the concrete and time-tested signs that have always preceded the largest market declines. More importantly, you will discover how to position yourself while others are panicking. The history of markets is marked by abrupt declines that caught most by surprise. In 1929, euphoria gave way to despair, and the market took more than 2 decades to recover. In 1987, in the year 2000, and in 2008. It was not just a correction, it was a destruction of decades of progress. Although the causes may seem different, the behavior of the market and investors has always followed the same script. First comes irrational optimism, then excessive risk, and finally, panic. The pattern repeats with an unsettling precision. And when this happens, recovery is not swift. It takes years. Only those who have experienced this know how painful it is to see years of wealth building evaporate in weeks. And if you think this is a thing of the past, just remember the Euro crisis or the decline of Deutsche Bank in 2016. The fragility is still here, disguised as stability. But what exactly precedes these collapses? There are a total of 4 signs. One of the most reliable signs that something is wrong in the markets is the widespread overvaluation of assets, when the price of stocks strays too far from the reality of the economy. One of the indicators most used by large investors to measure this is the so-called Buffett indicator, the ratio between the total market value of stocks and the country's GDP. When this ratio exceeds 140%, it is a warning that we are entering dangerous territory. This indicator was at a peak shortly before the dot-com bubble burst. The same occurred before 2008. The figures do not lie. When the market is worth significantly more than the real economy can sustain, a downturn is just a matter of time. But how can one monitor this practically? A useful tool is the website longtermtrends.net. There you can find updated graphs and simple interpretations of the Buffett indicator. There are also 2 other indicators that reinforce this analysis. The first adjusts stock prices based on the average earnings of the last 10 years. The second is the price-to-book ratio, which shows how much we are paying for the real assets of companies. The further removed prices are from the real economy, the more fragile your portfolio becomes. But this is just the first signal. The next is even more subtle and dangerous. But unrestrained speculation is like a slow fire that cooks the investor without them realizing it. When people start taking loans to invest or use margin as if it were income, the risk has ceased to be financial and becomes structural. Many investors begin to operate with complex derivatives that they do not understand. They sell volatility, leverage options, or enter structured products with dubious liquidity. The promise of quick returns is always tempting. This type of speculation can be divided into 3 categories. The first is explicit leverage, using money that is not yours. The second is ignorance disguised as boldness, when someone invests in assets they can barely explain. The third is herd speculation, entering because everyone else is entering. To protect yourself practically, create your own alarm list. Are you receiving investment tips from people who have never talked about finance before? Are you seeing ordinary people become influencers of miraculous assets? These are signs, and the more they appear, the closer we are to the top. The market never seems dangerous when it is rising, but it is precisely in that collective comfort that danger lurks. And if this sounds familiar, wait until you see the next signal. Market euphoria is perhaps the most seductive yet treacherous signal. It is when the general sentiment shifts from being cautious to being triumphalist. And when this narrative sets in, it brings with it a type of optimism that seems logical but is purely emotional. The media reinforces this behavior. Records are celebrated as achievements. CEOs become celebrities. Assets start to be discussed not based on profits or fundamentals, but on promises and projections. And this is where the invisible risk comes in. The entire system begins to feed on confidence, not on data. Recognizing this euphoria requires a simple yet powerful question. If everyone is right, who is analyzing coldly? When there are no more doubts in the market, it is a sign that doubt has been replaced by faith. And faith in the world of investments often comes at a high cost. If you feel that it is impossible to lose, or that there is no way this can go wrong, then stop and reflect. Because when euphoria takes over, logic disappears. And what comes next is something almost no one is prepared to see. The fourth signal is increasing volatility. When the market begins to move more than 1% up or down in a single day, repeatedly something is amiss. It is collective emotional instability reflected in the prices. The trading volume also changes. It rises atypically, indicating that many people are entering or exiting at the same time. This usually means one thing. The market is tense, waiting for a trigger. And when that trigger comes, even if small, the damage can be enormous. This is exactly what we witnessed in March of 2020. Within a few days, the indices plummeted by 30%. It was not just the pandemic. It was the chain reaction of an already nervous market that exploded when fear became concrete. Extreme volatility does not arise from nothing. It accumulates silently until it can no longer contain itself. Therefore, be attentive when movements seem exaggerated, even without significant news behind them. It is a signal that the ground is unstable, and most importantly, knowing how to identify these signals is only half the battle. The big question now is how to protect your assets when all these alerts appear. Most significant losses do not occur because the market has fallen, but rather because the investor has reacted inappropriately. Fear of missing out leads many to enter the market when assets are already at their peak. The herd effect in turn pushes crowds towards irrational decisions, such as selling during downturns. Many start justifying these decisions with arguments like, everything is falling, it's better to leave now, or if I don't jump in soon, I will miss the next rise. However, these statements are usually born out of fear, not analysis. An uncomfortable truth is that the mind of a rational investor collapses when the portfolio declines by more than 20%. This happens due to a psychological reason known as loss aversion. Losing €100 hurts far more than gaining the same €100 satisfies. This pain leads to hasty decisions. That is why safeguarding yourself from yourself is just as important as protecting yourself from the market. But how can you create a structure that does this for you, even when everything seems to be collapsing? Through intelligent diversification. Diversification is not just about spreading investments across different assets. It is about understanding the role that each part of your portfolio plays in different economic scenarios. Many investors believe they are protected simply by holding shares of different companies, but they all react similarly during a systemic crisis. True balance comes when you diversify by function: growth, protection against inflation, against deflation, and stability. Warren Buffett provided a classic example of this when he began to reduce his exposure to Apple. The stock had appreciated so much that it came to represent half of his portfolio. Even though it is one of the most profitable companies in the world, the risk of concentration was clear. He acted logically, not with attachment or greed. A common mistake is to diversify only within the Eurozone or only among technology stocks. But when the same variable affects all assets simultaneously, this diversification does not provide protection. It is merely an illusion of security. Now, if the goal is to create a truly resilient portfolio, there is a tested structure that goes beyond theory. The all-weather portfolio, created by Ray Dalio, was designed to withstand any economic scenario: growth, recession, inflation, or deflation. And yes, it can be perfectly adapted to the European context. The logic behind it is simple, yet powerful: to balance the portfolio by economic function rather than by asset category. In the version adapted for us here in Germany, it is possible to build this structure with exchange-traded funds. Equities can be represented by ETFs, such as the MSCI World. For long-term government bonds, there are also ETFs for government securities. The commodities portion can include physical gold, which also plays an essential role as a crisis hedge. Historical data shows that this portfolio demonstrated impressive resilience. In 2008, it fell much less than a traditional portfolio. In 2020, it recovered more quickly and with less volatility. The difference? The construction was made to endure, not to impress. And the best part, It does not require prediction, just rebalancing. However, there is one element missing for this strategy to truly work. What transforms a good strategy into real results is discipline. And the simplest and most powerful method for this is to invest without trying to guess the best moment, especially in times of crisis. Each month, you contribute a fixed amount, buying more units of the assets that have become cheaper. The very rebalancing of the portfolio makes you buy at lows and reduce at highs. All of this without needing to feel. Just follow the system, because in the long term, the average entry price is far more important than the exact moment you buy. This is how investors who traverse decades build wealth. They do not try to predict the next downturn. They are prepared for it, and this changes everything. If this content helped you reduce market noise, please subscribe to the channel and like this video to assist other investors in avoiding failure during the next crisis. The secret is not to predict the next collapse, but to be prepared for it. Strengthen your discipline. Protect your assets. Start today. We will see you in the next video.